Hello ladies and gentlemen, welcome to ChrisFX. Today we are going to go through the secrets around fair value gaps. I am making this video as a response to a video that I saw on YouTube which has several misinformation, and I'm gonna be making an update to this well-known channel that has made a similar video before me, and I'm gonna tell you which things are correct and which things are wrong and what the real secrets of a fair value gap are. And those tips and tricks are coming from me. I'm a very successful trader, haven't lost a single day in the past 2.5 months. So I am somebody who knows what he's talking about. Go ahead and watch the full video if you want to become a little bit better in your trading journey. So let's go ahead now and begin with the video, and we will go ahead and debunk everything step by step, starting from number one. And for those of you who don't know what a fair value gap is, we need to start with that. Maybe some of you are completely new over here. So if I am to first go ahead and check out what a bullish fair value gap is, I will place some numbers on those three candlesticks. This is gonna be number 2, and this right here is gonna be number 1. Okay, and I'm referring to this candlestick as number 1 and this candlestick as number 3, okay, right here, and of course this one as number 2. Okay, now what is my gap, the fair value gap? It is a gap in this situation, the bullish fair value gap. Remember my words, it is the gap that is being created from the low of candlestick number 3, and this is irrespective of the time frame. As an example, we are on the 1 hour time frame right here, and the high of candlestick number 1. So again, the bullish fair value gap is always created if there is a gap between the low of candlestick number 3 and the high of candlestick number 1. You see the gap on candlestick number 2. And why do we say that there is a gap? Because, as an example, if the wick of candlestick number 3 would have been like that, and it would have covered the whole area, so now you see there is no gap over here, this is covered, absolutely covered, there is no fair value gap. But in the situation where this is missing, as an example, as it is, there is a gap, an untested area on candlestick number 2. This is my bullish fair value gap. Generally speaking, it is very general, of course, we would be expecting for price to come back and do something like that, retest this area and keep going. You will see that this is not always the case. Now, a bearish fair value gap, let's go ahead real quick and show a bearish fair value gap. A bearish fair value gap, in this occasion, if we go ahead and grab those numbers and bring them over here real quick, let's see where they are. Yeah, they are right here, guys. Let me transfer those things right here. So in this occasion, it is the exact opposite. Let's assume that we have candlestick number 1, candlestick number 2 right here, and candlestick number 3, this candlestick right here. The gap that is being created by the low of candlestick number 1, and I'm referring to this candlestick right here, and the high of candlestick number 3, this is your bearish fair value gap. You would be expecting something like that price would come back and give you a reaction. And of course, on a lower time frame, this is a quite high reaction, but we're gonna show you the tricks around fair value gaps and debunk the myths around FVGs, also the myths from this very well-known channel, because the tips that they are sharing are not accurate. Okay, let's go ahead now and talk about which things are correct right here. We are going to number 2. We will be analyzing, we did number 1, what is an FVG. The mitigated FVGs is the one that we're gonna be talking about right now. Okay, so we are at number 2 right here. Number 1 has been done. A mitigated and unmitigated fair value gap. So, what is a mitigated and unmitigated fair value gap? Let's assume right here, let me get a perfect example. Yeah, let's assume that right here, we are right here exactly, and I'm gonna be going over here. If we were to just trade blindly this FVG, and if you trade blindly like that, you will never find success. You will find success if you follow the very specific things that I'm showing. I'm teaching the tiny little details that other people are not aware of, and they are not aware of the time frames that I'm using and the combinations that I'm using, which give me above 90%. Believe it or not, it is all in the signals and it is all in my trading results. So if I would go here, let's assume, and highlight this bearish fair value gap right now. Okay, what is a mitigated and unmitigated fair value gap? And this is a correct point that this other channel is making as well. If I move forward and I see a candlestick entering as it did, now if I was to say what is the remaining part of this fair value gap, the remaining part is the part from this area until this area right here. So this area that you see down here has been now mitigated. This area right here has been mitigated, as we call it, and now your new area, let's say, would be this area right here. So in order for a fair value gap to be, let's say, valid, it needs to be unmitigated. So in the future, now you see this was mitigated until here, and we see some form of reaction. Now, if this was to continue going, let's say, down and down and down, and if it would come back up, now you wouldn't be interested in this area right here that has been tested. You see this area that is tested. So you would grab this thing and you would highlight the part that is unmitigated, which is this part right here. So now you would narrow it down to this area right here. Okay. Now, let's go ahead and talk about another very important thing. Number 3, we talked about mitigated and unmitigated situations. Okay, do you want me to do a bullish example? I can do it on a bullish example as well. Okay, let's do it. Before we move on to number 3, let's assume that now we have this fair value gap, as we explained what a fair value gap is. Now, this is my whole area. If price does what it did, okay, it respected until here, and price, this is absolutely tradable. We will talk about it in number 3. My point now is number 2 still, what is a mitigated fair value gap? You see that it has been tested, let's say, mitigated until this area right here. This now has been tested. So if price is to come back in the future, let's assume that price leaves and comes back in the future, I'm not now interested in this area that has been tested. You see, this wick has tested it until here. I am interested into narrowing this thing down and saying that now this is the remaining part of unmitigating fair value gap, and this is the only area that I will be looking for a reaction from. Okay, this is a bullish example to the mitigated and unmitigated situation. So until here, as in the original video, I mean the video from this other channel, everything we agree with. Okay, absolutely we agree. Now from here and onwards, from number 3, number 4, and there is a small mistake in number 5, we do not agree with this other channel, and absolutely 100% I am right, guys. So follow what I'm telling you right here. Let's go ahead and analyze number 3. How the fair value gap is being respected. I partially agree with them only. So it is very important, yes, that let's assume that we have on the hourly time frame over here. It is very important. Let me see which example we're going to be doing. Let's start from this example, actually. Let's delete that over here. It is very important that a body of a candlestick does not close below the fair value gap. Okay, so on the time frame that you have highlighted the fair value gap, in this occasion the hourly, you don't want to see a body of a candlestick breaking, closing below. So if this bearish candlestick would have been like that, let me draw it a little bit better. So if this bearish candlestick would have been like that, I can do it not to confuse you. I will increase how large the candlestick is. If it would close below the fair value gap, yes, this is an invalid fair value gap. So if price now retraces back up, I wouldn't suggest that you go ahead and look for buys. Even if they work, I wouldn't suggest that you do that. In the occasion that you are trading the fair value gap, I would consider it an invalid fair value gap, and I agree with what they are saying also in this other video. Now, if the candlestick wicks below it and the body closes within the fair value gap or above it, even within it, such as in this occasion here, you are still very good to go. So consider this. On the time frame that you are identifying your fair value gap, remember that in this occasion, the 1 hour time frame, we don't want to see a body of a candlestick closing below. And in the situation of a bearish fair value gap, and this is a bearish fair value gap right here, we wouldn't want to see, for example, the body of this candlestick right here closing above. You see where the wick is? We wouldn't want to see a bullish body closing above. Then we would consider this invalid for short trades. Okay, it is fine if it wicks above it and it closes within, or it closes below. All of those candlesticks are absolutely fine. Now, regarding the reactions that you're gonna be seeing, we wouldn't care. Do not get confused and do not think that when you see a large pin bar, as an example, being created, such as in this occasion right here, do not think that this situation is always the strongest one. This is where the tiny little details come into play. But of course, if you want to learn exactly how I'm trading, guys, I'm not even using fair value gaps. I'm using them in combination with some other things, not alone, never alone. Okay, not that they don't work, but the things that I'm using work like a charm. So if you want to learn about them from a real trader, not a marketer, go ahead and enroll in the most precious program that you can imagine, which is my program. Especially the mentoring, you will get amazed. You will finally become profitable. Okay, but if you are the lazy type, do not come and enroll. You need to put in the work as well. Okay, even though you will see that this is working from day one, it's not like we will end the one-on-one and then you will test it on your own and you will see, oh, it doesn't work. You will see it working 80-90% of the times, even after the first one-on-one that we will do. This is 100% guarantee. Okay, so in this occasion, I would say, if you want, as another rule, if you are to trade, let's say this, do not, let's assume that you are not dropping on a lower time frame. I'm not gonna get into this. On the time frame that you identified the FEG, in this occasion the 1 hour time frame, it doesn't really matter, you shouldn't believe that this is stronger compared to a situation where this is gonna happen and the body, a full bearish body, is gonna be closing inside this area. Okay, do never believe that a pin bar guarantees that you're gonna be winning the trade. Sometimes remember that a pin bar, what it means, yes, it shows you some kind of strength. So let's assume that the candlestick started up there as it did, and it did a small move up, then it came down, and then it did on a lower time frame all of those things, giving you opportunities to go long. These, most of the times, will be manipulation for price to go lower. But when you see the very strong bearish candlesticks, as an example, this one right here, many times this is a very, very strong setup, even a stronger setup compared to a reaction such as a pin bar. Because now, people are shorting aggressively. Okay, on a lower time frame, there are a bunch of tiny, let's say, smaller bearish candlesticks that created this one candlestick, this huge one. And as this is happening and you believe price is gonna be going lower, then this comes into play and price goes ahead and leaves like that. Let's move that to the left. Okay, so do not believe that when you see a reaction with a wick, such as in this occasion, this is a stronger situation. This followed by this right here, many times is way, way, way stronger. Okay, as long as this body does not break below the FEG, this fair value gap is good to go. So this is another thing that I wanted to talk about, that of course they are not talking about, most likely than not because they don't know about those things. Okay, I don't blame them. I am one of the few that know about those things and are trading those things on a daily basis. So now we debunked number 3 of the secrets as well. We have done number 3, we have done number 2, we have done number 1. Now, number 4, lowest fair value gaps are not always the strongest. So lowest, I should say lowest or highest. Okay, they are not always the strongest. And you might be amazed to hear that. So premium and discount should never be absolutely the case. And I'm gonna talk about it. So if you trade Forex, this is the distinction right here, you would like to go and trade a premium or a discount. So in this occasion, as an example, if you would like to short from a fair value gap, it would be preferable that you will go and short from a fair value gap that is above the 50% level. So in this occasion right here, lovely people, there you go. This is a fair value gap which stands above the 50% level, and this is another fair value gap even more above. So if you're willing to sell, you should identify those bearish fair value gaps, as we talked about them in number 1, okay, which are above the 50% level and not below. So you wouldn't be interested in this fair value gap right here. And here in this example, you see the importance of what I told you. You don't always want to see a pin bar. This doesn't mean anything. It is even weaker, I would say. This is the perfect scenario. A body closes and another body gets created after that instantly. Okay, so since we made that point, I'm going to show you an example, also a bullish example. Let's take a bullish move. If you go ahead now and get this move, let's assume on the hourly, if we go ahead and place a Fibonacci from the bottom of this move until the very, very top, you would now be interested in trading in Forex those fair value gaps that are below the 50% level. My 50% level is exactly right here. I will draw a small blue line. So below it, we have this fair value gap, okay, as you see it. Below that, we have this fair value gap. And below that, we have this fair value gap right here, okay. And what did we say? The remaining part of that is that, because this right here was tested until here at the beginning. If we highlight the rest of it, you see how price comes, taps into it, and off we go from there, okay. For a lot of pips. Now you will tell me, but Chris, we would avoid, as I said, we would avoid this FEG, right off the bat, this FEG, and we would avoid this FEG for trading, right here, okay. Even though this is working, you would be avoiding it. Now you will tell me, even those FEGs below the 50%, 2 of them absolutely failed us. Yes, because you don't know the other secrets that I am teaching. I'm the only person who is teaching those things. And my areas, I will inform you very, very well right now. My points of interest, which I pinpoint, especially then with the footprint charts to the absolute tick, not only they get respected a lot, more than 90%, even if they fail, those areas can get respected from the other side again. So my areas hold high significance even in the future. Now, let's get back to our initial points. In this video that those gentlemen made, they said that number 3 says for them, or number four, you have to trade those FEGs that are in premiums and discounts. Yes, this holds only for Forex. If you trade indices, you have lost the whole game. So I disagree with them. As a generalized rule, I absolutely disagree with them. Absolutely. So right here, if you were to wait for price to get back, let's take this example. If you consider this as a whole leg, even from down here until up here, let me grab the Fibonacci, give me one moment. Until up here, you have lost the whole game if you wait for an FEG, for a retracement to an FEG below the 50%, meaning if you are waiting for this FEG down here. Price, test this one and it goes. Okay, then right here, however, it doesn't matter. However, you go ahead and you identify your premiums and discounts. If you would go ahead even here, let's say, let's find another example, an opposite example. Okay. Let's find the exact opposite example on a very strong bearish trend because it has to do with the trends. Look over here. Now maybe this is still a premium, I'm not quite sure. Let's see, no, it is not a premium. Okay. Yet, this is not a premium. This is way below the 50%. Still, price is testing the unmitigated part of this FEG. It was until here. It got tested until here. It is being tested a little bit and price goes ahead and breaks structure, especially with strong trends on indices, and it happens mainly on bullish trends. Another very nice example is this example right here. Price will never get back to the discount or the premium. If I grab it from here as an example, from where the move started, it doesn't really matter. You would expect for price to respect FEGs below the 50% starting from here. Nonetheless, price is testing FEGs on a premium, okay, in a premium, and off it goes from there. So I agree with them regarding Forex. Yes, I would say that number 4, premium and discount, lowest or highest FEGs are the strongest, but they are not always the strongest, because if you're trading indices, then you have to follow the trend, the strong trend. Price will never, ever come back to a premium or a discount most of the time, all of the times. If you have a strong trend, if you don't have a strong trend, sometimes it will. Number 5 is the last part of the secret to fair value gaps, and if you implement those rules, you will already increase your winning percentage. Let's assume that you are winning 30% of the times, which is exactly what you are winning right now. I'm pretty sure, no more than that. If you go ahead and gather your statistics, you will take that to a 43% instantly, let's say, with the tips that I'm showing you right here. And if you follow the ChrisFX mentoring or academy or signals, you will take this percentage. Of course, the mentoring, you will get the highest to an 80 to even 95% some months winning percentage. And you will tell me this is not possible, this is an absolute lie. Yes, then how haven't I lost a single day within 2.5 months? This is just a question. No one else out there hasn't lost a single day in 2.5 months. And I know even some of the strongest traders out there. Okay. Number 5, and the last point that we need to make, and we will wrap things up. FEGs, they said in this video, need to break structure. So as an example, for you to go ahead, let's say, and trade this fair value gap, this is a perfect example. Right here, as we have highlighted it, let's assume this fair value gap. There needs to be a break of structure, they say. Okay, so this break of structure, I don't care if you call it a change of character, those are words of a losing trader. I don't give a damn how you call it. So if you go ahead and say anything like that in my comment section. This is not a break of structure, this is a change of character, you are banned instantly. Okay, you are a loser in mindset and generally speaking. I don't care how you call it, I don't care about it at all. They say that you need to have a break of structure in order for you to trade this fair value gap. And this is a premium example, again, where you shouldn't be considering those fair value gaps strong. When there is a weak, most of the time it will get covered, guys, here. Okay. Anyways, what I wanted to say, this doesn't need to be the case. What doesn't need to be the case? That you need to see some break of structure. Those are things that only a very average trader would be telling you. Let's take this example. If you have identified, for whatever reason, a very strong grab of liquidity, such as in this occasion, as we see right here. Sorry guys, one moment. If you have identified this thing, as you see right here, and price retraces towards the upside, even without a break of structure, you will see, for example, that price will retest an FEG and go. And yes, you will tell me, there is a break of structure, Chris, and the break of structure happened here. Okay, guys, yeah, it happened to happen there. But I can give you another example where it didn't happen. It is this example right here. So, me personally, I would be able to catch those moves because I would have the area pinpointed even to the tick, something like that, let's say. Okay, over here, as I'm showing you also, I have shared some reels with proof of those things, of the live trading, but here there is no break of structure in this impulsive retracement back up, and you will see that this fair value gap, which happens to be a double fair value gap, of course, at the very same time, but we will not talk about that now, gets respected, and off we go. So, the fifth point is that, let's go back over here, you do not need to see a break of structure for a fair value gap to hold. So, this is a complete, let's say, video from a successful trader, not just a marketer on YouTube. I know what I'm talking about. I needed to correct some things on this video of those gentlemen. I agreed on half of those things, but the other ones are the complete opposite of what they are telling you. Yes, guys, you do not need to break structure in order for you to identify a fair value gap. Okay, if you identify, as an example, the strong grab of liquidity, you don't need to see a break of structure. You can enter from a fair value gap. Lowest or highest FEGs, premium and discount, I'm taking them from bottom to top now. Number 4, are not always the strongest. This is the strongest on Forex, but if you're doing indices, then many times you will be entering from an absolute, and I don't know what I'm drawing right here, you will be entering from an absolute, let's say, premium way more times. Okay, let's assume those are your FEGs right here. Let's assume that this is the premium FEG. Okay, somewhere here or whatever, in a huge leg. Sometimes price will do that most of the times and keep going from a premium. It will never come back to a discount, and the other way around, guys. It will never, if you want to sell many times, if we assume that we are in a strong downtrend, assuming that price is coming in a very strong downtrend, let's say, then most of the times the discount fair value gaps are gonna hold instantly and are gonna send price towards the downside instantly. Okay, so this is not always the case. Number 4 is not always the case. It is for Forex, it is not for indices. Number 3, we talked about the fair value gap and how it is respected. If a wick goes below it or above it, it is fine, as long as the body does not close above or below. But the wicks, the candlesticks that create wicks, such as this one, the huge pin bars, let's say, you have learned that those are the best reactions, they are the worst reactions, okay, that you can imagine of. And this is a secret that I shouldn't be sharing, but I'm sharing it with you. We talked about mitigated and unmitigated areas and how we redefined the area that is mitigated to the unmitigated area. And of course, we talked about what is an FVG. Follow those things and you will get your winning percentage from the 20 or 30% that you are currently in. And it's not a bad thing to be in this winning percentage. You will get them to the 45%. Then you enroll to ChrisFX, the one and only, the best and most transparent teacher out there, who respects the fact that you want to learn, and take this thing to a 90%, or go ahead and follow the scammers that you are following and keep losing money. It is absolutely up to you and it is fine. Subscribe to this YouTube channel, like the video, share it with all of your trading friends, and I mean it right now, and all of your family. This is gonna do it for today, traders, and thank you all for watching. Until next time.